This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Altco's Mainstream podcast. Today's episode is with one of the executives who has helped build one of the industry's leading alternative asset managers. We sat in Permira's London office with Co-CEO Dipan Patel to discuss the firm's evolution and how the business has grown to over 80 billion euros in AUM. Dipan brings deep background in private equity investing to bear as he and his co-CEO, Brian Reuter, now lead the firm through its next phase of growth. Dipan joined Permira from Gores Group and is co-managing partner and co-CEO of the firm. He serves on Permira Holdings Limited Board and Permira's Investment Committee and Executive Committee. He's focused on technology and services investing, working on deals such as Renaissance Learning, Informatica, Axiom, AllTrails, Ancestry, LegalZoom, and more. Dipan and I had a thought-provoking conversation about what it takes to build and run a scaled alternative asset manager and how to differentiate a firm and a culture. We discussed the founding story of Permira and the evolution of the firm since spinning out of Schroeder Ventures in 1996, how the firm's beginnings have shaped the culture that has been built, and how that culture has permeated how they make investment decisions, work with companies, founders, and LPs. How would an LP underwrite Permira's culture? How the firm's European heritage helps as an investor, the opportunity set in Europe, the investment culture at Permira and how its structure and setup helps investment processes and decision-making, why software buyouts have become a larger part of the buyout investing landscape, how AI is impacting software investing and how AI is impacting services businesses, why the firm decided to expand into credit, and the thought process behind launching a wealth solutions business and how it reflects the culture of the firm. Thanks, Dipan, for coming on the show to share the evolution of Permira and your expertise and wisdom in private markets.
In a collision of culture and finance.
We're going mainstream.
Dipan, welcome to the Altco's Mainstream podcast.
Thank you. My pleasure.
Well, thanks for having me here at Permira. So I want to touch on distributions because that's something that seems to be top of mind for everybody. What drove the distributions over the last 12 months? Was it the fact that you wanted to be able to distribute capital back to investors? Was it this was just the right time to exit businesses given macro influences? Talk us through that a bit, because I think that's something that people headline here, there's not a lot of distributions in private markets.
Yeah. The narrative, I think, for most GPs is it's a hard time to sell. We would say it's a hard time to sell B-grade businesses and definitely C-grade businesses. It's an exceptional time to sell A-grade businesses. Where you have very strong businesses, asset pricing has been as high as it's ever been, actually. You take our last sort of 12 months, we've had a series of businesses in good end markets, with good management teams, with good unit economics, with good predictability, and good scale. And they've been the kinds of companies that buyers want. And so we've been able to realize quite a lot over the last 12 months, actually.
Why is now a good time to sell those businesses, and why is demand for that as high as it's ever been? Is it because there's a flight to quality?
I think that's exactly right. I think, what tends to happen over time is when you get catalysts and shocks in the system, and we've been through that period over the last 6 to 9 months, the industry tends to gravitate, frankly, all asset classes tend to gravitate to quality. They go right up the quality curve. Part of investing is value maximization and return maximization, and some part of it is regret minimization. In times of stress, people want to, they probably over-index to regret minimization, which means they go right up the quality curve and they look for super stable, predictable businesses. And there's a scarcity of those. So you've got a fair amount of capital chasing a relatively narrow set of businesses, and ultimately in any asset class that ends up being fed into pricing. That's no different actually to public markets. Same thing happens in public markets. When you're in times of stress, there is just a straight flight to quality.
I think that's a good jumping off point to kind of rolling back the tape in time on both your career and Permira as a business.
Yep.
The business has gone through evolutions. It's gone through leadership changes. You and Brian are now at the helm running the business. I'd love to start with your background a bit so you can share a bit about your perspective, because I think what you just said is even more interesting in the context of you've been through multiple cycles now. Your perspectives on this cycle are probably informed by what you've done in the past.
My first ever job was early 2000s, joined a firm called Arthur Andersen, which no longer exists. And I was there for a year during the Enron scandal, where the company ended up eventually needing to be taken over by Deloitte. I then joined Lehman Brothers in 2005. And Lehman Brothers was incredible company with huge ambition, a different way of doing things, was scaling very fast, and it turns out too fast with the benefit of hindsight, and was there when Lehman collapsed in 2008. So, my first two experiences in my career were really big, interesting institutions with a real growth mindset and flamboyant leadership going bankrupt.
How do you think that's informed how you now look at the world? You're leading a firm.
Yep.
What kind of impact did that leave on you?
One of the things I'll never forget about working in Arthur Andersen and Lehman Brothers was the inability for management to accept what was happening. There was something about the culture of those organizations, which on the positive side and in the upcycle was driving it forward and leading to scale and expansion and a lot of great things. But at the same time, there was a very clear inability to speak truth to power. And ultimately, a number of mistakes were made. A lot of people had fingers in their ears. And I think almost right to the end, the leadership teams of both Arthur Andersen and Lehman Brothers didn't really believe that those businesses were going to go bankrupt. And, that was sort of a lesson to me. I think the other thing was, I'm not a big believer in heroes, right? I don't, this sort of single person knows everything, super charismatic, generally ends in tears. I'm a big fan of the Warren Buffetts and the Charlie Mungers and the Chris Hones, but if you actually listen to these guys, they have enormous understanding of the limits of their knowledge and their specialization, and they work on their biases and their ego and all those things. But I think if you go back and look at the leaders of Arthur Andersen and Lehman Brothers, they were ego-driven people at the top.
What do you think is the hardest part about investing in today's world? You add things like AI in.
Yeah.
What's the most challenging aspect of investing today?
The number of factors that are independent of each other that are coming at once. We've just come out of an environment that is low rate, globalized supply chains, cooperative geopolitics, and a set of tech enablers in internet, mobile, cloud that are mature, or at least maturing and understood. And we're now in an environment with persistently higher cost of capital, fractious supply chains, non-cooperative geopolitics, and this new thing, Gen AI, which is very hard to comprehend. And these are all, there are some linkages between these things, but they're simultaneously coming at every investment decision that we make. And so for more than any time, at least in my investing career, the next 5 years has felt unknowable and more unknowable, more unpredictable. And there is this constant feeling that we will be talking about things in 2 to 3 years from now, which are different to today. And that makes underwriting different and harder, frankly.
How do you think about underwriting then in the context of all the competing forces and factors that you just mentioned?
So this is a great question, right? So we think about this a lot. So in a world where you have very low predictability and things are fundamentally in flux and therefore unknowable, how do you situate yourself for good luck, right? Because you will get good luck and bad luck, but how do you get disproportionately situated for good luck? And I think that turns out to be the basics of private equity. Good things happen to good companies. So locate those good companies. Don't oversweat the macro and the interest rate environment and generative AI and all those things, but locate companies with truly incumbent positions, excellent management teams, sticky business models, phenomenal products, and scale, and put them together with a governance model and enough creation plan which really fits the things that you do well. You will situate yourself for good luck in those scenarios, because those companies invariably tend to attract the best talent, have the best cultures, have the ability to innovate and build new products and seize the day and then sell them into their customer bases, and flourish no matter what the environment is. It's a very simple answer to a complicated question, but every time we think about these questions, we come back to that basic question.
Do you think,
or basic answer, I should say.
Do you think that more investors are thinking that way in a time that's more uncertain? You mentioned it a few times, this flight to quality. Is that the case, that more investors are thinking about that? And if that's the case, as more capital flows into private markets, what does that do to the competitive aspects of making sure you're in those deals? I think that makes total sense. Being in good companies, you generally tend to win the day no matter what. But then the question is, what are you paying for that? And what are you exiting at?
Yeah, I think that's exactly right. So we rarely do well in obviously good companies at the starting point. You need surprisingly good companies. So you need to come at companies and be able to unpack a level of quality that is misunderstood by the average observer. If it's just a obviously high quality business with straightforward business plan underwrite, it will go straight to pricing and to returns. So that's the first thing I'd say. It's, locate surprisingly high quality businesses. The second is we really actively seek out high quality businesses with a lot of situation complexity. Okay, so massive public company overhang, shareholder that is in distress and needs to sell out, a high quality core but surrounded by some lower quality businesses. management team upheaval has recently missed numbers for whatever reason and has been sold off. Private equity fund that needs to sell. Just some situation complexity wrapped around an otherwise high quality business is we love. And so that's where we spend most of our time, frankly, not the obviously high quality stuff.
When I hear you talk about investing in good businesses and trying to find those complex situations, where my mind goes is that even if AI comes into the investment process more, and there's obviously a lot of data you can take, and probably even more as technology gets better and better in terms of being able to underwrite, there's still an artisanal element of underwriting and investing. What are the feelings that you have, like, in your gut when you're finding those situations where there's a good gut feel versus a bad gut feel when you go through some of those scenarios that you just described around, like, a complex situation with public markets overhang, or they missed a mark on the last quarter, or whatever it may be? How do you discern between that good gut feel and that bad gut feel that makes you invest or not invest?
When you're looking at a company, whether it's got a great product, it's in a great end market, it's got a really good team, the unit economics make sense. Like, they reveal themselves to you. And so, once you're able to access the company and the information and spend time learning, you can separate the situation complexity from the business complexity, I think, relatively straightforwardly. I'm not sure if I'm answering that question.
Yeah, no,
or not.
Absolutely. I mean, I think, look, like, at the point at which a company hits the radar of a private equity firm, yes, maybe there's issues here or there, but most businesses are going to be good businesses in one way, shape, or form.
Yeah.
The question is discerning the difference between what will go from good to great, what price to pay that matters, and then how you actually help the business and the value creation that gets there, right?
Yeah. And I think there are some things there's a standard set of things that we will always look at, and anyone who's a high quality investor in high quality businesses will look at. There's then the second order question, which is, which of those matter the most, right? Where do you want to over-index, and what are sort of like non-negotiables? The thing that we have tended to find is market leadership and distance in market leadership is, it's not just about being the number one, but it's being the number one by orders of magnitude can make a really, really big difference to companies.
That's a really interesting perspective, because I think at times with companies, you hear and talk about the founder story, or the executive who's in charge, that can shape culture and brand so much. How does that impact how you think about underwriting a business and partnering with founders and executive teams?
Look, we love backing strong founders, and that founder gene, it's like it's in a fraction of 1% of people. And when you locate it, it can be magic in a bottle, and founders can do things and take duration type decisions, which are, only found in the mindsets of that kind of person. It can be transformational for companies, and of course, there are so many stories over the history of time of phenomenal founders. That by itself, I don't think it is enough. Most of these strong founders had very strong teams around them, and they had an awareness of their own gaps, and they filled them with the right kinds of people. Whether it was Johnny Ive and Wozniak and Tim Cook at Apple, or it's Zuckerberg bringing in Sheryl Sandberg, and there will be a litany of these things. You see recently Sam Altman bringing in Sarah Fryer. These are wise decisions, I think, and if you don't do them, then you can run into trouble.
I think that's an interesting perspective to have when you think about the culture and business that you've built at Permira.
Yeah.
you have co-CEOs, you have co-heads of, I think, every business unit.
Yeah.
That's, I'm sure, a deliberate decision and an intentional one in the context of how you like to manage a business. I'd love to unpack that because not every firm does that. And I think that may be unique to the culture. So I'd love for you to share why you do that. And I think that probably informs and is indicative of what you just shared about how founders should think about building their own businesses.
Let me go, I'll take a couple of clicks back and go to the origin story of the firm. The way that Permira runs is a function of our history. Permira was founded in 1985. It was part of Schroders Bank, Schroder Bank. It was named Schroder Ventures. It was a standalone entity that was whose purpose was to invest in mid-sized companies primarily in Europe. It ended up spawning into about 9 different country funds, actually going as east to Asia and to Canada, and a number of countries across Europe. And in the late 90s, what ended up happening was 3 things that were just defining for Permira. The first was 5 of those country funds. So it was our UK business, German, Spanish, Italian, and French businesses came together. So these were disparate country funds and they came together to form one entity. The second was they extracted themselves and created a completely standalone partnership owned by the partners. And then they raised the first pan-European fund, which was around €1 billion, which was a long, hard fundraising at the time. It was really a first-time fund. But that fund ended up being enormously successful. The reason I start there and give this long-winded explanation to an otherwise simple question is the idea that was seeded in Permira as a result of those actions was all of us are better than one of us. And when we can access that diversity of talent, we are better. We make better decisions. It really came out of that, right? It came out of coming together and forming a partnership and a common incentive model and a common culture and a common investing strategy and alpha strategy and everything else that comes with it. So right from the inception, that idea was seeded, and so many things from there followed, but their roots sit in that moment and that set of decisions which happened between about 1997 to 2001. To your question, co-heads is really just a manifestation of that, right? It's the continuation of that idea that debate and honest debate, often between 2 people who are wired differently. And we very consciously put together System 1 thinkers and System 2 thinkers, optimists and pessimists. We sometimes use the words maniacs and minders. We like that. We think it stretches people. It means that things are beaten up from every different angle. And we feel more confident when 2 co-leaders come to the table with decisions.
Unpack that concept in the context of making an investment decision.
Yeah.
Where and how does that tension in a healthy way create better investment outcomes in your mind?
So look, our investing process is about more than just our co-heads. We have deal leaders and deal teams and a 6-person investment committee, and together we make those decisions. Look, ultimately, it's as simple as ensuring that the right level of debate with the right level of data integrity and thinking happens, and people are stretched in every angle. I think in the industry, the mistakes that get made the minority of them are actually analytical mistakes, and the majority of them are character mistakes. They are errors that stem from from biases and ego, and the way it manifests itself in a deal is, an unnatural desire and an unwarranted desire to do something, like take an action, buy a business, and that can often lead to mistakes. And having that wrapping around a deal, so leads of a sector, often a couple of deal partners on a deal, and then a overall IC, is a way of just ensuring that the investment process and the thinking has integrity. Yeah.
How do you underwrite character?
How do you underwrite character? Look, it depends on what context. I mean, let me just take it through a CEO angle. I think when we're hiring a CXO, can be a CEO, but an executive into our company, the first is track record, the decisions that somebody has made over time. And a couple of things that we always look for are, has this person done inflection? Have they taken something from A to B? Actually, it doesn't tend to matter how big the inflection is. It matters just more that the person has been able to come into a division, sometimes even of a business, and take something from A to B, and for that to be clear and noticeable. The other thing that we look for is people who are right a lot, right? And you have to do a lot of that through referencing. But ultimately, when you're an executive, you make a small number of very important decisions. It's a decision game, and therefore it's a judgment game, and you want to see a track record of somebody who, not always, but especially on the consequential things, has demonstrated a track record of making the right decisions. Then you get into the character stuff, I think, and look, different people will look for different things. I think for me, the rate at which you learn is a really important metric. It's very hard to pinpoint, but it's not about not making mistakes, because there's just no way you can go through an investing career or a operating career, especially at a high level, without making mistakes. But the speed at which you can convert a mistake into wisdom is something that we look for a lot. So we look back through history and try and diligence that with an individual.
I imagine if that's how you think about underwriting and partnering with executives and operators, that's how you think about things internally. How would you, if you were an LP, how would you underwrite Permira's character?
I think there's no one investing strategy or culture which is the best or the only way to do it. I think there is the sort of, what is required is you need to know who you are, right? It's the Carl Jung, the world's going to ask you who you are, and if you don't know, then the world's going to tell you, right? And you never want the world to tell you who you are. You need to wake up every morning and understand as a person and as an organization who you are, who you're not, what you're good at, what you're not good at, and stick to that. Even in a world that it's trying to pull you this way and that way. Permira's character, or maybe culture, is the other way of thinking it. It starts there. It's rooted in what do we do well, and sticking to it, which is really about who you hire and how you hire them, and how you translate stories down the organization, and drive accountability and all of those things. The best cultures are the ones that thrive in chaos and get better out of chaos. Because the world is very chaotic. We're not going to control that, and it will only continue in that direction. But there are organizations that tend to be broken by that, and there are organizations that are resilient to that, and then there are organizations that actually get better as a result of that. This is the concept of anti-fragility, right, from Nassim Taleb, right? And that's how I think about our culture and our character. If you look at Permira's toughest moments, Permira always emerged a lot better as a result of it. It's not that there isn't an absence of mistakes and errors in Permira's 40-year history, but there is the presence of us getting much better very quickly as a result of the stress. And I think that is more than anything what our LPs are underwriting with us. It's not that we won't make mistakes. It's that we will learn very quickly from them, adapt, and move forward.
I think that certainly does. The next question in my mind gets to capital flows. So
Yeah.
obviously you, amongst others, are now working with the wealth channel. There's more capital coming into private markets. How do you feel about that from a perspective of, you mentioned this a number of times, making sure we deliver a great product to our customers, in this case, LPs.
Yeah.
How do you feel about the flow of capital coming into private markets and still being able to generate the types of returns that you want to for your investors?
I think if you're really good at what you do, it's going to be a really good thing. And if you are a commodity product being sold through a commodity channel, then is this going to be a really tough environment for you? And what does that mean in practice? It means there's a lot of skill in being able to develop theses, put the firm in unique positions to invest in businesses, drive a real alpha generation program through the life cycle of investment, position a company for exit, and then execute it. Right? It's very hard to do that consistently over long periods of time. And if you do that and you do that well, this actually will just be another exit channel. We like it because for us, we look at this as really a fourth, maybe a fifth today exit channel. And we've always had strategic exits, sponsor exits, IPOs. They're in our secondary products and there'll be retail products. And so, it makes total sense that there will be capital that will come into this market. I remember my old economics professor from Cambridge in our first macroeconomics class talking about Say's law. Say's law is supply creates its own demand. And that's what will happen because the industry is pushing so much product. It will create demand, right? Households are not waking up today saying, I want to be in private wealth. It's the supply and the branding and the product and the marketing that is creating that market. So that will be there and it'll be, I think, a persistent, permanent and very big feature of the market.
Do you think that's the type of thing that certainly over time, as more people become educated, brand is something that starts to resonate with both end investors and their advisors, if they're advisor-led, will just become a more commonplace part of a portfolio? Because I think when I hear you talk about that this supply creates this form of demand, there's also an element of the majority of businesses that grow and have value are in private markets, and yet that hasn't been available to many people. Right? So, and like 87% of companies in the US with 100 million in revenue or greater, private. Up 90+% in the UK, similar figure in Europe. So is this, in your mind, a necessity for people to have access to private markets? Obviously in the right way.
Yeah.
But when you think about that concept of supply creating demand, that probably unfolds as a major story in private markets over the coming years.
There's no such thing as necessity, right? There's really just, what is your risk tolerance? What is your timeframes? And what are your return desires? And different people are different. And for the right audience, and there will be a very, very big part of the market that for whom private markets will make sense and be relevant, which is why I think this will be a permanent and at-scale feature of the market. This is, for all the reasons you just said, will be an important part of overall portfolio construction. The trouble will be for the part of the market that don't fully understand what they're getting into, because at some point you hit some stress moment and gates probably need to go up, and then you have a potential regulatory overlay that may come on top of that. And that's not a question of if, that's just when, right? And it's likely to happen at some point over the next maybe next year, it may be 10 years, but at some point that's likely to happen. I think the industry will be tested, and then it will get through that.
How do you think about that in the context of managing a firm that is working with wealth, but also doing it in a way that fits your culture as you think about the industry will have to get through some of these things as it's changing? You grew up in a private equity industry that was really the domain of institutions. Not a small market, but it wasn't the size and scale of what it is today. How do you think about navigating a firm through some of these industry evolutions?
We're very fortunate. We have hundreds of limited partners who invested in us at scale through cycles. We're a private partnership. We have very strong capabilities in the areas that we play: sectors, geographies, capital markets, value creation, and so on. For me, it's as simple as don't get distracted, right? As long as we know what we're doing, stick to it, apply it every day, and generate strong returns for our investors, this will be the area that we play in. We will become increasingly differentiated, probably, to our investors. And so our focus is really to continue going deeper where we play, rather than trying to go broader in our products or our capital distribution.
How do you balance differentiation?
Which, by the way, is an anomaly, right? I think in the market, and it's one of the reasons why we think we will end up becoming differentiated over time.
I think this is a inherent tension for many firms, because you're a private partnership, but you're still a business, and the business of asset management itself is also a fascinating concept and a very good business for that matter as well. You invest in software. You could argue it's asset management is as good or better than SaaS in many respects as a business, right? There's a lot of the features of it. How do you think about balancing that tension of continuing to grow your business, but at the same time making sure that you're differentiated?
I do think there is a trade-off there. I think as you broaden and try and scale, particularly too quickly, you become defocused, distracted. The core ends up usually underinvested and suffering as a result. Our growth as a firm, therefore, is really focused on very long duration, patient, methodical scaling. We're not trying to be the biggest, and we're not trying to actually grow very quickly. There is an obsession with growth. And in the industry, we have an obsession with growth in our companies, in our portfolio companies, and doing a great job and creating great companies. We really believe if we just keep doing that and doing that well, we will be able to methodically and patiently grow our businesses and grow adjacencies that make sense for our investors, back to like building products that make sense. We want to build products that have synergies with the core, like makes our core better and generates returns for our investors. And there'll be plenty of those over time, and we'll do them methodically and organically.
So let's talk about the businesses you invest in. So I think your platform is constructed in an interesting way where you have growth investment strategy all the way through to buyout mature businesses across both tech and services. How do you think about how investing in earlier stage businesses, they're growth companies, not startups, to be clear, but how that informs how you invest in and help build businesses that can become larger in size and scale, but also vice versa. So you're able to see what good looks like from investing in more mature businesses, and how does that reflect back on how you think about investing at the growth stage? Yeah,
so our growth business will underwrite equity checks from about $50 million and up, and has a starting revenue loosely of around $50 million and up. So these are definitely companies in growth stage. Our buyout business will write equity checks all the way up to 2 billion euros and into very large scale mature companies, often or can be worth 10, 15, 20 billion euros at times. That gives you amazing lens and aperture on what's going on across verticals and end markets and themes that you play in. And the synergies are bidirectional. So on the one hand, it can give you confidence in what you're doing in the growth stage, because you understand the profit pool and the weaknesses of certain types of businesses in certain types of industries, and it helps you to underwrite the probability of hitting underwriting cases. At the same time, it helps mistake avoidance in our flagship product. We're thematically organized around end markets and themes, and the same individual is scaling up and down both products. It's a single integrated team.
Why do you do that?
For this reason, right? You can see the potential risk coming down the road from a disruptor, and that can help you avoid making mistakes. At the same time, it can help you avoid overthinking. You can sometimes over-worry about what a disruptor might do. But actually seeing some of those businesses up close, you can, identify a series of problems with certain businesses that can lead you to conclusions that they won't scale and they won't end up being disruptive.
You mentioned earlier on about that investors sometimes are too focused on managing risk at the expense of other things when it comes to investing in good businesses, and trying to generate returns. But there's also an interesting point embedded in what you just said about an investor or a team focused on everything from growth all the way through to buyout, is that investors can decide where they want to play on the risk spectrum.
Absolutely. And
how does that help how you think about and underwrite a business? Because maybe you miss a business earlier on because you decide it's too risky at that point in time, but then you're able to build a relationship with the founder and team or executive and then say, okay, maybe it's a little bit more expensive, but our risk has been mitigated a bit.
All businesses eventually, and it's just a matter of time, hit some maturity level and a mature level of growth and get valued at mature company EBITDA, free cash flow, PE multiple levels. So the real question is, is that happening at $100 million of revenue, $1 billion of revenue, $10 billion of revenue, $100 billion of revenue, right? And a lot of the skill in investing is just understanding that runway, the market position that company has, and the ability to execute through that curve. And then figuring out where in the growth curve the best risk return sits. And so, it's enormously valuable to be able to have products that allow you to watch a business from about $50 million of revenue up to a few billion of revenue and sort of make that judgment over time. And that's what we do in different categories. We take a view that we want to own the incumbent. And in other categories, we decide we want to own the disruptor. And in some categories, it's something in the middle, right? And it varies depending on moats, usually.
How do you think about what you just said, owning the disruptor versus somewhere in the middle versus the incumbent, in the context of the current snapshot of time we're in with AI?
Yeah.
And impacting how that might either help incumbents better run and manage their business, or also help disruptors who are fast followers, maybe not as encumbered by some of the legacy aspects of services, aspects of their business, or they're not able to apply AI as fast. How do you think about that as it relates to what you're investing in now? First
of all, there's a platform shift. Platform shifts in technology are always transformational, and what tends to happen is thousands of applications end up getting built on top of infrastructure layers, and there's a lot of disruption in industry profit pools. Now, there's a difference between disruption and destruction. Okay, a lot of people hear the word disruption and they automatically assume destruction. There will be, in our minds, definitely a lot of disruption. in some industries, it will be, and frankly, we think in a lot of industries, potentially the majority of industries, the incumbents, particularly where they are early to AI themselves and they're embedding AI at speed into their core workflows and their products, will end up winning. In other industries, the moats are just not as big. And you have businesses that have extracted supernormal profits, where you will see, you will definitely see a level of disruption.
When there's a platform shift, where do you think the most attractive place to invest is? Is it in the disruptors who are able to do things differently? Or is it, like you mentioned, and I'd love for you to unpack why you think in some cases incumbents actually may be the best place to invest on a risk-adjusted basis when it comes to investing into platform shifts?
It depends who you are, right? So if you ask this question to a public market investor or Permira or Andreessen Horowitz, or a seed investor, you'll get you'll get a different answer.
On that point, though, I think there's an interesting framework here for LPs, and
Yeah.
yes, LPs can play along that risk spectrum, and one could argue they should probably have exposure to all points along those risk spectrum.
Yeah.
But there's an interesting question worth wondering, which is, and this is where my mind goes when you say an incumbent actually has a really interesting opportunity set ahead of it if it is early to adopting something like AI to make it, you're making a good business better. Does that make private equity an even better risk-adjusted investment in today's world where you're using AI to make a good business better and take the rule of 40 if it's a software business to something greater than that?
The thing that you have in private equity, or in buyout private equity, is control. And that allows you to get around a table and make decisions at speed with companies, number one. And number two, it gives you a duration lens. We're not market to market, and we are really solving for terminal year growth and terminal year EBITDA. So we can take, decisions along the way, particularly investment decisions along the way, that may depress short-term EBITDA, but allow our companies to just have longer duration and be more valuable at exit. So that in and of itself is a structural advantage over most other asset classes. Then you layer on top of that incumbents that have brands and distribution and technology, and they can go one of two ways, right? I think if you sit on your hands and you're not alive to these platform shifts and the capabilities that they will enable, you will be at risk from someone in Silicon Valley in a garage that's building some equivalent at a fraction of the cost. But if you are, I think it was the CEO of Adobe who said it, companies who use AI will overrun companies that don't use AI. So I don't think it's as simple as, this company's in trouble and that company's not, or this end market's in trouble and this end market's not. I think companies that don't use AI very quickly and start embedding this into their cost workflows and their revenue workflows will suffer. It turns out to be the case that in PE, we tend to own more of those market-leading incumbent businesses at scale and with the resources and with a control mentality, governance model, actually, that allows us to lean into this.
Generally with incumbents, I think they're big but not often stupid.
Yeah.
How do they make sure that they are properly navigating this time, especially with things like AI, and what will separate the ones who do it well versus the ones who don't?
A CEO, first and foremost, right? So if you don't have a CEO who has this as a top agenda item, probably the top agenda item, you're in trouble. Like if this becomes a CTO project, a CPO project, and just another capital allocation decision down there in the system, that's a problem. You need a CEO that owns it. You need a culture in the organization that embraces it, like there will be resistance in businesses. I mean, most functional areas, they want to tinker and play with AI, but, workflow change management is not really fun for most people. And so the level of inertia and resistance within organizations is the big problem, right? It's not the technology. The technology is there or will be there. It is all the human stuff that's happening in very large businesses. So therefore, the businesses that have a culture of speed, embracing innovation and adaptability and interest and curiosity, matched with a CEO that is driving it from the top, I think magic will happen there. And we see it in our own companies. We have companies like that, and we don't have to do anything. We arrive, we'll come to the board meeting and they will be driving at breakneck speed. And there'll be other companies where it's much more problematic. But it all starts there.
We talked about this a little bit, this is such an interesting point in time to invest because, particularly for like the services businesses side of your portfolio, AI is impacting that. I think you mentioned before, or in one of our conversations about like the private equity invested in directories back in the 2000s, right? And that was at a time when Google was just starting to really kind of eat into that business. Yeah. How do you think about investing in and helping services businesses that may be already in the portfolio or could be in the portfolio today as you look out 5-10 years from now?
So look, I think there are, the direct example, just to hit on that for a second, is just an interesting case study of inertia in the industry. And it goes to, I'll deviate for a second from your question, it goes to this specialism, and the industry has moved in the direction of specialism from generalism to specialism over time, is an absolute fundamental requirement of investing. However, specialism without the right cultural overlay can be really dangerous. The problem with specialism is you tend to focus on where the puck is, and then that turns into where the puck was, and that stops you focusing on where the puck's going. Early 2000s, Google was scaling, and because in the 90s a lot of people made money investing in directories, really from the early 2000s all the way through to about 2006, private equity funds were continued investing in directories businesses. Why? Because a number of people had grown up as specialists and had made a lot of money in directories investing. Now, if you fast forward to today, and by the way, all of those ended up going somewhere between bankrupt and capital loss, depending on the situation. So, that was traumatic for a number of funds. You fast forward to today, you will see in professional services, which is a big segment of private equity investing, investors continue to invest in the types of deals that made them money over the last cycle, without an understanding that the facts have changed, and at a minimum, the risk level has gone up, and therefore the return premium you need needs to go up. We are over-indexing to the much more complicated, bespoke, white-collar end of the market, but also with the understanding of the limits of our own knowledge and the understanding, therefore, that even these companies, can be disrupted. But where you are like really deeply embedded, where you're doing something complex, so it's not a repeatable commodity task, and where you're doing something which is really repeatedly embedded in the workflow of your customers, and in particular where it's high stakes, super high stakes, and you can't get it wrong. You can't get it wrong even 1% of the time. We feel today more protected And we think, when I said earlier, companies that use AI will overrun companies that don't use AI, we think that there will be enough time, you'll have enough duration, and with a control model, you will be able to invest in the areas of the workflow that are adaptable and amenable to AI. And we're really excited about that. Like that set of companies that have those features, and particularly where they're collecting some sort of unique data, which isn't available in general training sets that they can use to improve their product and extend their product. That's a really interesting and rich vein of investing, I think probably for the whole private equity industry. So that's where we're focusing in professional services. And we are much more wary today of anything that doesn't look like that. Whereas I think even a few years ago, we would have made a certain set of investments that I think today we just wouldn't.
The comment on where the puck is going is a great segue to the last question that I always like to ask people, which is, I think we're at such an interesting time. It's not, to your point about investing, looking back. So rather than ask what your favorite or most interesting investment in private markets is looking backward, I'd love to hear what in your mind is your favorite or most interesting investment idea looking forward.
Let me say it this way. If I was to invent a whole new private equity fund with doing one single thing and could make only one bet, it would be this. It would be within professional services, where you're doing complex white-collar work with deep workflow embed, where you can take AI to fundamentally reimagine the workflow and then reinvest that back into the product cycle and the sales cycle. That would be the area that I would be spending all of my time on.
What do companies need to do to be able to have that? How do they orient their services business in a way that has AI as a core piece of what they do, but are still a services business?
CEO. Like, unless the CEO wakes up in the morning and says, this is mission critical, and moves at us with speed and urgency and drives a certain level of accountability, it won't get done. The answer is really, as ever, it's nuanced, and there are 15 different things that need to come together. But if I had to pick one, it would just be that. Everything else flows from that.
I think that's a great way to wrap this up, because I think we touched on mission critical investing. As a firm, you have to think about how you do things in a mission critical way. You've touched on that with Permira as well. So it's a great conversation.
Thank you.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going